The secret to consistently build robust strategies is exploiting patterns. Patterns is one of the most powerful way to build strategies because usually, well, most of the time, they are hidden. And if you find it and exploit it and you add some filters, then you'll have a unique set of rules for your robust strategy. In this video, I will reveal two patterns. They are the up and down thrusts. Now, usually I don't do these patterns on the channel, at least, because usually they involve something complicated. In this case, these patterns, although they are very simple, but they require finding a pivot. And pivots, it's kind of tricky. I mean, you can find it easily, but in programming, you need to take care that you avoid the look-ahead bias. So let's draw a high pivot. So let's assume that we have 4 bars, and let me change the color here. Okay, so this is the pivot high. And as long as the pivot high, as long as this bar is higher than the bars on the left and higher than the bars on the right, that's called a pivot high. Now, this interpretation is open because you can use the close higher than the previous closes. Also, you might require that each high is higher than the previous high. In our case, in this pattern, we're only looking for the center bar, this guy, to be higher than the bars on the left and the bars on the right. This means if I move this bar here, the pattern will still be true because this high is higher than all these highs. Now, currently, this pivot has 4 bars to the left and 2 on the right. So the right strength is 2 and the left strength is 4. So this pivot requires 4 on the left, 2 on the right. And that's why I say it's a little bit tricky, because only here you will know that the pivot happened. Like, you need to wait for 2 bars after the pivot happens, then you will know that the pivot happens. And if the strength was 1, then you will know over here. And if it's 3, then you will know over here. And so on and so forth. So when the program shows this pivot happened, you cannot act next bar. You need to act after the second bar. And this is what I mean by the look-ahead bias. Now, most platforms will behave properly, meaning they will issue the signal after the second bar and when we have the right strength as 2 bars. But when you're backtesting, you need to keep account of how many bars when that happens. So that's what you need to take care of. Once you take care of that, then it's very easy. So we'll start with the up thrust pattern. So the up thrust pattern is for long, and the rules are as follows. We wait for a high pivot to happen, and then we wait for an open above the pivot, and the same bar close is lower than the previous 2, and also the same bar close is in the bottom of the range. So let's show that with an example. So here is what I mean by the up thrust pattern. So we are looking for a pivot high that has 4 strength on the left, 2 strength on the right. Okay, so this is the bar. And then after the second bar, we need an open above the pivot high. So the red bar means it's a down bar. So that's the open and this is the close. So the open needs to be above the pivot high. And then the close needs to be lower than the previous 2. So this close is lower than this and it's lower than this. And also the close of the same bar needs to be below the 50% of the range. So this close below the 50% mark. Once we have all these conditions met, then we will go along on the next bar. Our exit will be when the RSI2 above 80 or fixed 10 bars. Now, this is a general exit. It works on any single pattern you trade for short term. So short term, RSI 80, you should get it within 2-3 bars. If it doesn't happen, you give it a little bit more chance. If it doesn't happen, then you exit after 10 bars. Now, to optimize this pattern, we can change the number of right strength from 1 to 2, and we can change the left strength from 1 to 4 or 5. And then we keep everything else as the same. So obviously, if you have one bar on the right, one bar on the left, you will get more trades. And if you have more bars, like 4 or 5 on the left and 2 on the right, you will get less trades. Now, one last thing to keep an eye on is this bar doesn't have to be the third bar on the right. So when the pivot happens, you have a window of when this bar will happen. This is also optimizable. Like, let's say this has happened now, and then 20 bars later, without a new pivot, you get this bar. Then that's also valid. Like, you can decide what's the window size. And here we can visualize this on a real chart. So this is the S&P 500 futures, the daily session. The indicator at the bottom showing two things. The green bars are pivots, and the plus cross in yellow, these are the rest of the conditions. So remember, we have high pivot, that's the green bar, and then the open greater than the pivot, and the close lower than the previous two closes, and the closes in the bottom of the range, this is the cross sign. And so you see, sometimes we get a pivot, but we don't get the other conditions. So again, here is a pivot, we don't get the condition. Here we get a pivot and we get the condition. And notice, because the window here is more than 20 bars, so this condition applies to this bar. So this is the pivot, and then this condition here, the open is greater than this pivot, and the close is lower than the previous two closes, and the close is in the bottom of the range. Then we get all the conditions. Because remember, the right strength is 2 bars. So in reality, this pivot happens, we are still trading every day, and then this pivot happens, but this is bar 1, so this didn't paint yet. And then this is bar 2, didn't paint yet, and only here actually where this one will paint. So that's why what I told you in the beginning, you need to pay attention, because there is a look ahead bias when you backtest this kind of pattern. Now, of course, that's the beauty of algo trading, because once you program it, you don't need to think about it. It's all happening based on your rules. Like, there is no room to interpret, is this true or is this false? It's either true or false, and there is no ambiguity in the explanation of the pattern. So this is an example of the strategy of 4 bar strength on the left and 2 bar strength on the right, high pivot. So this is a pivot, and at this bar, we have the open higher than the pivot, the close below the 2, the close at the bottom. We issue an order to buy next bar. Next bar we buy, we get this pivot painted. It's fixed 10 bar exit or the RSI above 80. And then here, same thing. So this pivot did not paint here. So then this bar, the open, is higher than this pivot high. And this bar, the close below the previous two closes. Also, the close is below the 50 range. And so we issue an order to buy next bar, which happens here. We exit with RSI 2 or after 10 bars, and so on and so forth. But you can see we don't have trades all the time, but we're having them when we have these cross. Now we can optimize this, and you can see the pivot left strength from 1 to 5, step 1, the right strength from 1 to 2, step 1, and then the look back period, like how far we want to go to look for a pivot. We can optimize this from 10 to 30, and then the window. So the window is once the pivot happens, how far can I go to look for the next condition? And I'm going to look from 3 to 21 in a step of 2. So all in all, we get 1100 combinations. Here are the results sorted by return to drawdown. And we can see that 4-2 shows at the top a lot, so that seems good. But the look back period is 10, and then the window is all over the place, so I think it doesn't make any difference. Actually, here the top 5, they don't make any difference. So from 11 all the way to 21, they're all the same. So I'm going to pick like the middle, so 4, 2, 10, and 15. So this is our strategy now. 74 trades with 81% win rate with about $690. And that is a great strategy for the S&P 500 E-mini futures. This is the equity curve. It's very smooth. We have a kind of big drawdown here. And then the annual period analysis. So far, only 2019 is a loss. I mean, 2018 is a scratch, but overall, very good performance. The only thing is the low number of trades. So 74 is definitely on the low side. Now, the down thrust is a short pattern. So we are waiting for a low pivot, and basically everything is the opposite. So low pivot, open below the low, and the close is higher than the 2 previous closes in the upper range. And then we go short. Now remember, shorting on the S&P 500 is difficult to find strategies with it, and even if you find it, usually it's less trades. But let's see what we get. So first, here are the rules. We need a low pivot, the open below the pivot, the close higher than the previous 2 closes, and the close is in the top 50% of the range. Now the exit, you see here I put 4 bars. So the RSI 2 is the opposite. Instead of above 80, we will exit when it's below 20 because we are shorting. But always, this is a good tip to keep in mind. Always with short, you need to exit quickly because shorts in the indexes, they don't last a long time. So instead of waiting 10 bars, you always shoot for 3 to 5 bars. So I put 4 in the middle. And here is the strategy applied. So this is the low pivot, and then this open is below the pivot, and the close is higher than the previous 2 closes, and the close is in the top range. So we issue an order to short next trade. We will exit when the RSI 2 hit below 20 or after 4 bars. And let's see the performance. So we have 38 trades, and overall we are losing. So let's optimize and find something else. And here are the optimization results sorted by return to drawdown, and you can see we are barely making profitable strategies. So these guys have 22 trades, 23 trades, and if I scroll down, 18 trades, 19. So I will pick the same window and look back for the long side. So 1, 1, and 10, and 15. So only 22 trades at 870 on average. So this is how the short side look, 22 trades, about 60% win percent, and $870. And this is the equity curve. Of course, it's going up, but I mean, we don't have enough trades. But at least we can combine it with the long side to see what we get. Okay, so now we have the 2 strategies combined. Now remember, some trades will overlap. You see here, for example, if the short order was issued while we are long, then the long will be closed and we will enter short. And same, of course, on the opposite side. Overall, when we combine them, we get 134 trades with an average of 615. And the equity curve now becomes much, much better than both of them. In fact, we can see this because now our return to drawdown gets to over 7. So the long side was below 6, the short side was below 6, but combining them, now we are over 7 because we are adding the profits and reducing the drawdown, which is the beauty of any portfolio. And this also can be considered the portfolio long and short. Of course, if you watch many of my videos, then you know the S&P 500 is a mere reverting instruments tend to drift up most of the time, which means it works very well with all long strategies. So what about we think out of the box? Okay, what about we turn the short pattern into another long pattern? So the pivot up, close goes below, we go long. Also, the pivot down and the close goes up, and then we also go long. So that's 2 different signals to go long. So let's see what we get. So here is the low pivot now used as a long signal. So this is the pivot, and then the open happens. Now, instead of going short here, we are going long. It's exactly the opposite. So here is the optimization result sorted by return to drawdown. Not a lot of trades because remember, it's the same pattern. But now we have more strategies profitable. So we can pick this pattern. It's 1, 2 with a look back of 10 and a window of 5. So this one is making 67 trades and $35,000 with an average trade of 531. So again, that's really good. This is how the equity curve looks like. So now we have 2 patterns to go long and 1 pattern to go short. We can combine all of them in a single strategy. Now, sometimes the long side, because we have 2 signals, sometimes they overlap. So we need to allow the strategy to take 2 orders if they overlap. Of course, the short side will always be a single one, and it will exit all longs to get short. So this is the combinations when there is no overlap. So we're only allowing 1 long signals. We get 168 trades with an average of 547. So that's still really good. And if we allow the strategy to take 2 signals, so allow 2 order entry when the order is generated by a different signal. So this is how it looks like. And now we can see we have 181 trades, still having the same average trade. And now let's also add the short side. So overall, now we have 22 short trades, 185 long trades, with a total of 207. And our average trade is great. Of course, the short side is amazing, but our average trade is still very, very good with about 70% win rate. Now, our return to drawdown, of course, we are looking to enhance it, which is very good, 6.58. And our equity curve became much smoother, of course, because we're adding different signals at different times. We are not using position sizing, like we are not leveraging the same signal again. We are using different signal. So that's what makes this portfolio very good. And now our annual period returns looks like this. So 2015 is a scratch year, 2018 is a losing year, and then everything else is very good. In fact, last 5 years, this been an amazing strategy. Although keep in mind, this strategy is not in the market all the time. Look at this. It's only 18% of the time it's in the market since the past 17 years. Even though we're making really good return, our capital is not used all the time, and it's available to be used for other strategies. The power of portfolio of strategies, never underestimate that. Short, 2 different signals for long, and only with 3 strategies we have an amazing portfolio on the same instrument using the same code on one chart. If you like this video, you will love the next video.